This market has had a lot thrown at it, and the $1 million question is, how much can it take before it becomes too much to bear?
Hey everyone, thanks for tuning in to our March 2026 Investment Committee update. I'm Chad Smith, a managing partner at Reveille Wealth Management and part of our investment committee. Today, Stephen Weitzel and I are going to share our latest market perspectives and how we use our rules-based investment discipline to inform the current positioning within our investment strategies. I'm currently working remotely this week down at the beach with my family for spring break, which explains the different background that I have today. We also hope that everyone enjoyed a great Easter weekend. And for all you golf fans out there, happy Masters Week. So let's get into it. Military action in Iran caused major disruptions to markets in March. While U.S. stocks had been weakening for some time, this geopolitical catalyst sent stocks falling between 7 to 10% for the month. Commodities were the lone investment category to gain in March, bolstered by oil prices, which surged around 50%. Gold and silver, ironically, both declined by 14 to 15% respectively. The sudden rise in energy prices has spurred inflationary concerns, which resulted in a jump in interest rates and a losing month for bonds. Rising defaults in private credit or non-bank lending markets remains a key macro concern for the U.S. economy. Based on historical seasonal standards, the next 2 quarters are the most difficult of the entire 4-year presidential cycle historically. The combined effects of these developments in March resulted in several intermediate-term trend signals turning off under our rules-based investment discipline across multiple equity asset classes. So I'll now turn it over to Stephen to take us through this month's review.
All right, thank you, Chad. Now, as we begin, I want to remind everybody that you need to verify that you're subscribed to all of the places that we are posting content so that you can be notified as soon as it is available. First, the Reveille Wealth Management YouTube channel. Here you're going to find timely market insights, financial planning ideas, as well as our Bugle Notes podcast series. Next, to subscribe to our weekly show on Stock Market TV, type Stock Market TV. The thumbnail is going to look like this for Stock Market Media. Click to visit their channel, then navigate to playlists. From there, you'll find our show entitled The $1 Million Question. Click the link for any of our episodes there. Once an episode begins playing, you can find the subscribe button below and click it to be alerted when each show goes live every Thursday at 10 a.m. Eastern Time. So with that out of the way, let's jump in to our March review. Now, this market has had a lot thrown at it, and the $1 million question is, how much can it take before it becomes too much to bear? So we've been talking about some of this for months as a reason to be cautious about the headline U.S. stock market indexes. Historical 5-year forward returns, when the S&P 500 begins with a price earnings multiple as high as it was as of late 25, those forward returns tend to be around 0 or even less than 0. And when you couple that with the fact that the 10 largest stocks in the S&P 500 index make up almost twice the amount they normally do, you're beginning with a market that's not only as richly valued as it's been, but it's never been less diversified. So the U.S. market has also largely been priced for perfection. Most of the economic problems that the rest of the world has dealt with over the last decade or more haven't really impacted the largest U.S. companies in the same way. They seemingly have been immune. But now, economic weakness may be starting to set in. Job growth has been slowing for the last couple of years, and now AI-related job losses are becoming more common. Add in the issues that we've been documenting with private credit and how trillions of dollars of investor money that has been presumed safe is now experiencing some significant challenges. Default rates, which had been expected to be extremely rare, they're now pushing 6%, according to Fitch Rating Agency. And during COVID, those defaults were as high as 8%, and they were 10% during the financial crisis. Well, UBS has recently come out saying that they believe that in their bear case scenario that defaults in this space could reach as high as 15%. So the question is this going to be a significant market headwind or a systemic market headwind? Is it a little s or a big S? Only time will tell. Even if defaults do not continue to escalate, though, the pricing that is being reflected in these portfolios, these funds that people are invested in today, is still probably egregiously inaccurate. Investors may be told that their positions are worth 98 cents on the dollar, when in reality they may be worth closer to 65 cents on the dollar. So the more that these investors demand their money back from these funds, the higher the likelihood that these funds are going to become forced sellers of these underlying positions in order to raise cash to return to their investors. And where prices ultimately plumb in that environment is really hard to quantify. But my guess is that's a scenario that's going to have Warren Buffett's name written all over it. So all of this had been weighing on the market. Now we enter this military conflict in Iran, and we can't presume to know what the knock-on effects of this are going to be. But we do know that fuel prices have risen 50 to 60%, and the prices of other goods are going to rise as a result, and inflation is going to be higher. How temporary is it going to be? That's the real unknown at this point in time. So how did the markets fare in March? Well, not well, as this Iranian conflict seemingly came out of left field. Through the 30th of March, the S&P 500 was down almost 8% for the month. Small cap stocks were down a little more than that. International stocks were down 11, 12%. As I mentioned earlier, oil prices were higher. That was the outlier, something that was up, the only thing that was up. As a matter of fact, oil was up almost 60% in March. And because that stoked inflation concerns, interest rates ended up rising considerably, and bond prices fell over 2% in the month of March. The biggest surprise to me, if you had told me going into March that this conflict was going to break out in Iran, I would have guessed that stocks would have gone down, oil would have gone up, but I might have also guessed that bonds would have rallied and interest rates would have fallen because of a flight to safety. I also would have never expected that the price of gold would have fallen by double-digit percentage points, but it did. So even if we were told the outcome of things before they happen, it's still very difficult to try to predict how the market would respond. Now I want to go back to this chart that we've looked at for several months now regarding the level of concentration risk in the S&P 500 index. The 10 largest names in the S&P 500 making up nearly 40% of the index's market capitalization. Now, it's been the strength in those names that has masked a lot of weakness beneath the surface in the U.S. market for several years. But we've been worried about the sustainability of that. Well, we're not in Kansas anymore. The S&P 500 is now down almost 10% from its all-time high of around 7,000, but it's now being weighed down by the biggest names that carried it to that level. Not a single one of the 10 largest stocks in the index is actually outperforming the index in this measure as far as how does it stand relative to its former all-time highs. Berkshire Hathaway is the best performer. It's only 13% below its former high, but Microsoft, worst of the group, it's down 35. Now I show the S&P 500 energy sector. Here, it was at a new all-time high as of the 30th of March. Unfortunately, the energy sector, it only accounts for about 3% of the S&P 500's total market capitalization, which is less than half of Nvidia's market capitalization. One company worth more than twice the entire market capitalization of the entire energy sector. So even though we had about a 30% advance for the energy sector in 2026, that can only offset about 60% of the decline that we've seen in Nvidia in terms of market cap deterioration. Now, coming into March, we had spoken about how the diversifiers in investors' portfolios had started to outperform the S&P 500. Finally, some alpha for maintaining a diversified portfolio. And we shared then that investment categories that tend to struggle relative to most of their alternatives, they're also tending to struggle on an absolute basis. And that certainly has been the case so far for the S&P 500. Now, despite the S&P falling less than small caps and international stocks in March, these patterns still seem to be rolling over in favor of these diversifiers, especially commodities, right? If you notice this change, right, look at how pronounced this rollover was in the month of March. So commodities staged one of their largest periods of monthly outperformance ever relative to the S&P, mostly attributed to this increase in oil prices. Unfortunately, many investors don't maintain exposure to commodities in their portfolio anymore, but we believe that they should. Now, we're in year 2 of the 4-year presidential cycle, and this year is the choppiest, most volatile historically of this 4-year period. Now, we never want to blindly follow seasonal or historical trends. We want to align with actual trends in the market. But we had been following this analog pretty closely until early March, right? When we said last month that our expectation should be that things are not going to be as strong as they were in January and February, we didn't expect quite as abrupt of a shift as we saw, but we certainly got one. Now, we should reasonably anticipate some continued choppiness for the next 2 quarters because they're among the worst 2 quarters of the entire 4-year presidential cycle analog. So we may need to buckle our seatbelts here. Now let's move on to the charts. The S&P 500 no longer in an uptrend, right? That is big news. It had been in an uptrend, in a fairly steady uptrend since May of 2025, but it has now entered a downtrend per our rules-based discipline. How far down could it go and over what period of time? We don't know. We never know the duration or the magnitude of these moves. But our perspective right now for the S&P 500 should be that it is guilty until proven innocent. Mid-cap stocks, they are trying to hang in there. They are testing not only this uptrend line that has been in place since the late spring of last year, but we're also trying to hold these former highs from Q4 of 2024. So we're going to hear that a lot in the review today. If we are above these former highs, then we can own mid caps. We can have some exposure to mid caps. But if we are below that level, that is going to be consistent with a bear market, and we want to be out. Small caps, same story. Russell 2000 index nearly triggering a sell signal per our rules-based discipline, hugging that uptrend line, but also retesting these former highs from October of 21, Q4 of 2024. If we are above these former highs, we can be comfortable having exposure to small caps. Below that level, we want to be out. Developed international stocks are also now in a downtrend, though they remain about 15% above these former highs from 2007. Now, if this market correction that we're in now, if it deepens, if we are in for a larger corrective wave, I wouldn't be surprised to see that we retest these former highs down here. But we never know exactly what the market has in store. But for now, we do acknowledge that this trend that had been very powerful, one of the strongest advances that we've seen in the space, has now, at least temporarily, come to a conclusion. Let's move to emerging markets. I've recently said that this might be the most important chart in the world right now. Now, the emerging market index, it finally broke out above the pre-financial crisis highs back in January of this year, and now has come back to that former level of resistance that has been in place since 2007. Now, these former highs, this former level of resistance, it should turn into support. If it does turn into support, which may be the higher probability outcome, then this probably becomes very reminiscent of the secular breakout and retest that took place in the S&P 500 index in the spring of 2013. This becomes a great mulligan for investors if this prior resistance turns into support. If it cannot hold, if it enters a downtrend and we end up down here, it is probably getting very ugly around the world. That would be a pretty nasty bear market. So this level is one that we are watching very closely. Now let's move to commodities. As I said earlier, this was the lone asset class that was positive in the month of March, buoyed higher by a nearly 60% rise in oil prices. Remember, it was only a couple of months ago when we were talking about commodities being range bound, and if they could break out above these 2023 highs, that we could probably make a run at these highs from 2022. Well, we didn't expect that it would happen quite that rapidly, but it did. Now, it would seem likely that some digestion and consolidation would be in order as we are revisiting those former highs, right? So if you have had some exposure to commodities in your portfolio, great. These are levels where we think it's probably responsible to try to sell some and at least rebalance your exposure back to your target weighting. Now, in our February review, we talked about how the potential for rising commodity prices could stoke concerns around inflation, and sustained inflationary concerns could potentially thwart any efforts that a new Fed chair might have to lower rates further. And I think that is exactly what the bond market started to sniff out in March as we saw those commodity prices rise. So we're still in an uptrend here for bonds, but barely. We're back below this congestion zone right here, and the longer we see commodity prices, namely oil, energy, remain elevated, the higher the likelihood that we're going to see interest rates continue to climb and not fall. That would not be a great environment for bond prices, so be alert. Bonds are supposed to represent your safe money, but they too can enter downtrends. We saw that back in 2022. Bonds can lose money, right? So it may become necessary to exit your bond positions today as well if they can't maintain the uptrend that they're currently clinging to. We're going to end this portion of the review looking at REITs, the Dow Jones Equity REIT Index. So it had broken out above these former highs late last month, but that breakout was very short-lived. So we're back to a more trendless environment for REITs. They aren't in a downtrend, which is the best thing that I could say for them. And the sooner that they could reclaim those former highs, the better. But for right now, just a trendless environment in the REIT space. Now, if you're tuning in on YouTube, that's the end of this portion of the review. I'm going to hand it back to Chad for a recap, and then I'll leave us with some final thoughts.
Thanks, Stephen, for that update. To recap, the conflict with Iran caused major disruptions to markets in March. While U.S. stocks had been weakening for some time, this geopolitical catalyst sent stocks falling between 7 and 10% for the month. Commodities were the lone investment category to gain in March, bolstered by oil prices, which surged around 50%. Meanwhile, gold and silver, ironically, both declined by 14% and 25% respectively. Despite the potential for economic softening due to the conflict, interest rates rose during March, driven by the dramatic rise in energy prices, spurring inflationary concerns. As a result, bond prices fell and mortgage rates rose during the month. Rising defaults in private credit or non-bank lending markets remains a key macro concern for the U.S. economy. Several intermediate-term trend signals turned off under our rules-based investment discipline across multiple equity asset classes. At this juncture, we will continue to monitor trends in the markets and adjust accordingly, with a keen eye on risk management. Stephen, any final thoughts?
All right, thanks everybody again for joining us for this review. We hope that you found it insightful. As always, if you have questions, never hesitate to reach out to your advisor or send us an email here at info@reveillewealth.com. Thanks for joining us. We'll look forward to seeing you here next month. Take care, enjoy the spring, and we'll see you soon.